Hi, I'm Tim Phillips, the General Counsel of the American Cancer Society. This is Larissa Kern, Assistant General Counsel of the American Cancer Society, and we welcome you to another in a series of webinars that's provided to you by the Pro Bono Partnership of Atlanta. The mission of the Pro Bono Partnership of Atlanta is to maximize the impact of pro bono engagement by connecting a network of attorneys with nonprofits in need of free business legal advice. To be eligible to participate in the programs provided by the Pro Bono Partnership of Atlanta, an organization must be a 501c3 nonprofit located or serving those in the greater Atlanta area and serving those that are disadvantaged or low income and cannot afford legal services on their own. You can also get more information about the Pro Bono Partnership of Atlanta by visiting the website, and that is www.pbpatl.org. And you can learn about all the programs that are offered by the Pro Bono Partnership. As I mentioned at the outset, Larissa and I are attorneys with the American Cancer Society, and the American Cancer Society is the world's largest voluntary health organization dedicated to eliminating cancer as a major health threat by diminishing suffering through research, education, advocacy, and service. The information we're going to provide today is general in nature, and it is not intended to be legal or tax advice. So as we begin our webinar, I wanted to give some picture of the landscape within which nonprofit, and especially 501c3 organizations operate. And I wanted to do so by giving a picture of where these organizations fall within a broader picture of corporations in general. And in doing that, give you some idea of what separates the 501c3 organization from the normal business corporation that we're used to seeing. So in the diagram, you see there is a large circle that has all corporations included in it. And then as you go down in size of the circle, you come to the nonprofit corporation. A nonprofit corporation is basically dictated by state law. Next in size is the tax-exempt organization, which means that there is some ruling in effect or indication from the Internal Revenue Service that that organization is in fact tax-exempt. And in each one of these layers, you'll note that there are additional regulations or obligations that a corporation must abide by. Lastly, within the smaller circle, you see the 501c3 organization. And again, that is the client that the Pro Bono Partnership of Atlanta is serving. And if you are watching this webcast, you are either part of one of those organizations or working for an organization like that in an advisory capacity. So when we talk about what the 501c3 does, it has attributes that really belong to each one of those layers of corporations. Obviously, it is a corporation, has to be by law. There's also the nonprofit part of its existence, which means that under state statutes, it's considered nonprofit. It's also tax exempt. So there's an application that goes to the IRS where the organization discloses to the Internal Revenue Service what it intends to do, why, for purposes of Section 501c3, it's charitable. And that gives it an additional status, which means that people or corporate entities can give it money and get a tax benefit from that in the form of a tax deduction. So again, all of these layers do bring extra regulations. And one aspect of the public charity, the 501c3 organization, that's important is that they must operate for the benefit of the public. So a broad community service should be provided from their operations. Another additional layer that can bring complexity to a 501c3 organization's operations is what is known as the tax on unrelated business income. In the slide before this, we saw that there was a circle that included all corporations, and corporations generally have to pay tax on their revenues. Within the circles, we noted that there are organizations that are considered tax exempt. A 501c3 organization fits within that envelope. However, there can be taxes on a 501c3's revenues if they're deemed to be derived from activities that are not related to the 501c3 organization's mission. That is, its charitable enterprise. So, to be unrelated means that the income or the revenue that comes to the corporation is generated from activities that don't substantially relate to what the charity has told the IRS, and for that matter, the public, that its charitable mission is. And these are typically activities that would normally be considered commercial in nature or of a business nature. And additionally, the activity must be what is known as regularly carried on. So that means that it's carried on with the same type of frequency that one would expect a business corporation to conduct those same activities. There are some exceptions to the rule as it pertains to 501c3 organizations. In one instance, if the activities are undertaken by a purely voluntary force, so that the employees themselves, those who are doing the activity, are not paid for the service they provide, the tax won't apply to the revenues generated from that activity. Another instance where the tax does not apply is where the goods or the services that are being provided in exchange for the revenue are themselves donated. The most common instance of this type of exception is what I call the goodwill exception, where goods are donated to Goodwill. They are in turn sold by Goodwill to the public, but the revenues that are generated from that activity are tax exempt because, again, the goods that are sold have been donated. The concept that an organization that is a 501c3 needs to come away from as it relates to the unrelated business income tax is that looking at activities that an organization engages in should be viewed through the lens of whether they're commercial in nature. Would this be carried on as a business if it were outside of the charity itself? And if the answer to that question is yes, then some special care and precaution should be taken to at least minimize what the impact of the tax could be on the enterprise. One clear example, as it relates to the theme of this webinar, which is corporate sponsorship, is income or revenue that comes from what is known as advertising, where you are, in effect, putting out some form of statement that advances another commercial entity's interest, whether it be a statement about the quality of their products or their services, and you do so in a manner that generates revenue. A common example could be putting actual statements in the form of what look to be ads in a publication that the 501c3 puts out for sale to the public. At this point, I want to turn it over to Larissa.
Thanks, Tim. So I think we're going to get to the meat of the program now. Tim has set the scene, giving us the tax background. So let's really talk about sponsorships now, what they are. And when we're talking about sponsorships today, we're really trying to talk about qualified sponsorships. What are those sponsorships that we can do that help us avoid the tax consequences that Tim is talking about? UBIT isn't in and of itself bad, but most nonprofits want to avoid paying it. We want to get the full value of our sponsorships and not have to actually pay any of that as taxes. So with that background, what is a sponsorship? It's a payment in return for limited recognition benefits. I think for most nonprofits, we see it most commonly with respect to galas or sponsorship of events or programs. In exchange for the sponsorship money, limited goods and services can be given, but they have to be de minimis in value, and Tim will talk about that a little bit more in our presentation. So what are some things that you could give a sponsor and not trigger UBIT? We talk about that a little bit on this slide. The biggest thing, and it's probably what most sponsors want, is acknowledgement. They want to see their name and logo at the event. They want to see it in the program. They want to have that prominent recognition of their sponsorship of the event or program. We can also provide samples of the sponsor's products at our events. That's something that we do at ACS. If you go to one of our Making Strides Against Breast Cancer walks, you'll see the water there of one of our sponsors, Athena. You can also give the sponsors location and website. But this is something that you have to be careful about. You can give the general website address, but what you don't want to do is push people to an actual product page or any page that contains pricing information. It needs to be a general website. We can also display the product. That's quite common, again, at events, that if you have a sponsor like Coca-Cola, then you might have a display of their product there. And, of course, banners and collateral materials. Again, sponsors love to see their logos all over the place. So what are some of the things that we need to avoid with a sponsorship? Well, as nonprofits, what we can't do is go out and use qualitative language and say that our sponsors' products are the best, that they're number one, or any other sort of qualitative language. That gets into some of the advertising issues that Tim talked about. The other thing is payments that are contingent upon the number of attendees at an event. Your sponsorship dollars should not vary depending upon any kind of variation in attendance or anything like that. Again, that looks like they're being given, the dollars are being given conditionally, and that shouldn't be the case. Exclusivity is something to be careful with. You can have an exclusive sponsorship, but if the exclusivity is so broad, it can be deemed to have value in excess of the 2% that Tim will talk about later on. Generally, when we talk about exclusivity, we try to limit it to a category, and maybe the business category that a sponsor is, or limit it to a particular program. Most nonprofits will not have an exclusive sponsor of their nonprofit. That would definitely be bad. That's not what we would want to do with the UBIT rules. We can't provide pricing information for products. That's what I spoke about before. We can't push people to a particular product, web page, or provide pricing information with the product. And of course, we can't go out and say, go and buy our sponsors' products. And again, advertising. Advertising is the big one. No advertising on the website unless you want to go ahead and pay UBIT.
And that's actually a good segue into the next portion, which really does deal with a special part of the definition of what a qualified sponsorship is. And again, these are rules that are promulgated by the IRS. They're within the Internal Revenue Code and the regulations. So because they do come from that source, they can be complicated. But I'm going to talk about them in what I consider to be simple forms. So when we talk about exchange of value in a sponsorship context, really what we're looking at is what possible or potential benefit or actual benefit is the sponsor receiving in return for that payment. So Larissa just spoke to some things that are absolutely within the box, so to speak, of available benefits that can be provided to the sponsor. So an acknowledgement, the publication of their website, assuming you don't send them to a product or services page. Um, the acknowledgement language that is not qualitative. It doesn't promote that sponsor or its products or services. Those are all within the lines of what's permissible and won't trigger what could be considered basically advertising income. But the threshold that the Internal Revenue Service is looking for, where there may be some form of return benefit, so some value that goes back to the sponsor in exchange for their sponsorship payment, is known as the 2% rule. So we're looking at trying to gauge what is known as the fair market value of that return benefit and gauge it against the total payment. And if it's deemed to be at 2% or more of what was received from the sponsor, then you can trip into what is a taxable scenario, where what could be deemed to be taxable is the value, the total value of that return benefit. Some examples may be helpful. So if you provide that exclusivity to the sponsor, there may be value associated with the type of exclusive arrangement that sponsor gives. In other words, what kind of money would they pay to receive that sort of exclusive arrangement with someone that wasn't a 501c3 organization? Or you may have an instance where you provide, or the organization provides their sponsor, again, in return for their sponsorship payment, a tent, space, promotional space in a venue where they actually have products and services. This is what I call the sort of trade show example, where this sponsor is given a tent, a booth, an area within the 501c3's control, where they're actually set up to do what is promotion for their activities. What would they pay to have that kind of venue, to have that kind of space provided? And if the value of that is deemed to be 2% or greater of the total payment that the charity received, then we have to do an assessment of how much we received as the sponsorship and what would be a payment for the return benefit. And that portion, that is the payment for the return benefit, is actually subject to the tax. So that's the area that we talk about when we look at what the sponsor is receiving as a return benefit and whether the 2% rule has been triggered. There are other areas that you want to pay attention to in a sponsorship, but from a tax perspective, that's really the critical areas. When you look at your sponsorship, you want to make sure you understand what you're providing to that sponsor. Is it within the what we'll call the safe harbor of benefits? So logo site, logo placement, website announcement, and those types of benefits. Products can even be shown. Those are well within the safety guidelines. But if there are other things that are being provided, then you want to take those and assess what their value would be if they were provided outside of the context of the sponsorship.
And I'm going to throw Tim a hypothetical because it's one that we get a lot, and I'm sure you all are probably seeing the same thing. We get a sponsor who wants our staff to hand out coupons.
Mm-hmm. Yes, this is something that's actually more common than I wish, but it's an instance where you have to do the assessment. So coupons themselves are actually advertising. Now, the IRS has informally stated this. It's not something that I've found to be published, but I know that the position that they take when it comes to coupons is that they are effectively enticements, and they're enticements for those to come and buy products. So if you are handing them out as the charity, and the context within which you're handing them out is that you've received a sponsorship payment, then you have to take the time to step back and look at what would be the value of that kind of service if someone else were providing it to the sponsor and charging them money for that. And if that value, the fair value of that kind of service to do that is at or above the 2%, you've got an issue where you may actually have to pay tax on the amount, on some amount of what you spend.
And I think that the other hypothetical that we see a lot is the tickets in exchange for the sponsorship, the tickets to the gala, the tickets to the golf event.
So all these items do have value, and you have to take those into account. Is this a sponsorship payment, or is this a payment in return for some good or service that you're providing? So again, it can be a tricky situation. The rules were designed to provide some kind of safety net for organizations so that they could receive sponsorship payments and they could acknowledge their sponsors, but they needed to do so in a manner that didn't result in what is effectively advertising for their products or services.
So moving on, just to kind of recap some of what we talked about. So why would a nonprofit do a sponsorship? Why is it beneficial? Well, if you have a good sponsorship program, they're pretty easy to roll out. You think about events with tiered sponsorships, that's a really easy thing for your staff to go out and sell, particularly if your menu of benefits is set and you already have lined up the tax issues that you don't have to worry about. It's actually easy to sell and easy to document as well. And again, if you do it correctly, there's a low risk of EBIT, which means all of that income can come in and be used by the nonprofit rather than having to pay a portion of it to taxes. So what are additional things that we should consider? Sponsor of what? Is someone a sponsor of an event? Is it a sponsor of a program? You want to make sure in the agreement with the sponsor that that's clear. Sponsor of the overall organization is just not something that you see. So think about exactly what it is that you want the sponsor to be a sponsor of. Reputational issues with sponsors. This is it's a general issue, but if you're a charity in a particular space, you may have to view it differently. Obviously, we're at a healthcare charity. How we view our sponsors and the companies that we work with, it's going to be different than maybe a charity that is in the helping the homeless space. We may not want to work with the same types of companies, or we may just have to consider how we work with them a little bit differently. Again, the charity can't endorse products or services, and we want to make sure that we're controlling use of our marks. We want to make sure that we're very specific with the sponsor about what they can do with our marks, how they do their acknowledgement on their own webpage. They are a sponsor of what? What marks can they use? And you want to make sure, too, when you're doing your sponsorship agreement, that the licensing language for the trademark is very clear, and that you have your quality control language in there, too, where you're keeping control of your mark. You're either reviewing the mark before it is being used, or you have a set statement of what the sponsor can use and the places where they can use it, and that you have the right to review it as well.
I'm going to put in an additional plug for Pro Bono Partnership of Atlanta, because if there are questions about licensing, trademark use, and the like, there are resources available to you from the Pro Bono Partnership of Atlanta.
One of the things that we see at our organization is we have a donor that comes to us. They want to give us money for a particular program, but then we find out that there are strings attached to that donation. And that can make actually what would just be a straight donation look more like a sponsorship. And that's just something to be aware of and to think about. And if you're agreeing to any of those strings, it may be better to think about it in the sponsorship context and to think about the 2% rule that Tim spoke about and the tax consequences, because while whether it's taken as a donation or in exchange for services, how that looks to the company is not so much our concern. We still have the concern about if that income would be subject to UBIT or not. So So in summary, sponsorships, we want to acknowledge, but we don't want a call to action, no qualitative statements and no endorsements. And if you want to avoid UBIT, then you want to limit any goods or services that are given in exchange for the sponsorship.
Well, and I have to get in one final plug, not because we are lawyers, and that is all the things that we've talked about today as it relates to sponsorship, and especially those arrangements that seem like they could be sponsorships, but you're not quite sure because there are the strings attached. You need to have them documented. You need to have any of these relationships that you have with a corporate entity well documented so that there's an understanding between the parties about what kinds of return benefits will be provided, and you know that it's in a written document that you can refer to at a later date. Hopefully, that's not something that will ever become an issue, but if it does, it's always extremely helpful to have the written document in the form of a contract, an agreement, where both parties have written down what they intend to do and what their expectations are, and have signed it, and then you can go about the business of bringing in money to your nonprofit. And I think with that, we're at the end of our webcast, unless there are any questions from the audience out there.
We have some questions, so we're waiting here.
This might be the time when we say now there's a word from our sponsors. We got it. It's like we have a question that may have come from the audience about the sale of T-shirts, and I'm not sure if that question is selling the corporate sponsors T-shirts or the charities T-shirts. There are various rules out there about the sale of products and services and whether that revenue is going to be taxable. In the corporate sponsorship context, if a T-shirt bears the logo of the corporation, then it would be considered a product of that corporation. Handing out the T-shirts is one issue, and I would put that in the closer to the box of the water that's providing an event. Selling the T-shirt itself, however, is revenue generated with a product that bears the name of the corporate entity that's sponsoring you, and that again could be considered a return benefit to them because they're getting the benefit of your sales force. So the question is, it's clarified that it's the charities T-shirt.
We're just selling T-shirts to raise money.
Right. Yeah. And that's a common. I mean, we see that in many circumstances. There is a concept that is known as a low-cost item that the IRS has sort of spoken to, and the rules are old. They've been around for quite a few years, and I would certainly say that as a practitioner are in dire need of updating. But a T-shirt today is more than likely in the box of a low-cost item, an item that one would typically find. I think where you can find some interesting fact scenarios is what kind of item is it? Is it just that simple T-shirt, or is it an expensive item? And what you have to look at there is if it is in fact what would be considered an expensive item or something that's really not low cost in nature. How is that promoting the mission of the charity? Not that there's revenue generated, but how is that action itself going to um, promote your mission?
Here's another question. If an organization receives, say, a $5,000 sponsorship and gives the sponsor 10 tickets in return, each ticket valued at $100, so $500 for one benefit, do they need to pay you this um, on that amount, of that portion of what they give back in return?
So we received a question with specific facts about a sponsorship and a $5,000 level in return for what I believe was 10 tickets at $100, so about a $1,000 benefit, assuming this is some kind of an event. And again, it's all the facts and circumstances around around these specific questions are important and have to be analyzed as to whether or not that kind of a return benefit generates the tax. Um, what kind of event is that? What drives the value of the $100? Um, because it could be that is it in fact a sponsorship, or is this someone who's come and they're providing presence at the event, and so there's entertainment that's involved, and that's what drives that value. So there's a meal, there's entertainment, and that what they'll receive is in fact a receipt that says what you gave us is $5,000, but what you actually can say is the tax deduction for you is only $4,000 because you got a return benefit of $1,000.
So is it safe to say that the issue of people really concerned in the advertising context and not in the return benefit of those tickets?
So to clarify the question and the response around sponsorship and return benefit, keep in mind that the types of sponsorships that we're talking about are what are known as qualified sponsorships. So really what the IRS is trying to differentiate is those instances where a sponsorship actually looks more like advertising, that the return benefit that a corporation receives looks more like that advertising benefit. So exclusivity, qualitative language about the products or services, a website link that takes you to their latest and greatest products or services. So those are the types of return benefits that you really want to be careful of, and that you have to then go through extra analysis of if they're provided to see whether they do hit that 2% threshold.
Another question, doesn't clarify. What's the news around having a logo on your website? And I think the question is, can you just have a sponsored logo on your website without clarifying what they're sponsoring? Or do you need to make that very clear? And how long can you have that logo up on your website in conjunction with what they're sponsoring?
Those are good questions. The question really is about logo placement on a website. Can it be there without some specific reference to a sponsor's relationship to the organization? Is there a particular term after which you shouldn't have that logo up there? And I would say that those are primarily business questions. There are questions that the organization should consider before placing anything other than its own intellectual property on its website. So if an organization has a logo that is prominently placed on its website, you first have to consider from the corporation, meaning the charity's perspective, why is the logo there and what is it connected to? Because if it is just there, the person viewing it without context may come to their own conclusions about the relationship that sponsor has to your organization. So I would say to you that you should never have another person's or another entity's logo on your website without some context. As to the period or the term that again depends on what the underlying reason is for having it there. If there is a particular promotion, that logo should appear for the duration of that promotion and really no longer. Because at that point, you are providing some return benefit to that corporation that exceeds what we consider the arm's length of the transaction. So if in return for sponsorship payment, you give them acknowledgement, and that acknowledgement is their logo on your website, it should go away when the termination of the sponsorship period occurs. And I think with that, we don't have any more questions. Well, it's been my pleasure.